Our first LOS asks us to evaluate and explain past performance using ratio analysis. So, how do we use our ratio analysis to explain past performance and how it ties up with the stated strategy of the company? Well, of course, what we're going to look at is things like key ratios, how have they changed and why have they changed. Think about DuPont here, looking at return on equity, comparing it year on year and trying to analyse why ROE has changed. Of course, we'd also look at key ratios and trends and compare them with competitors and industry averages. So remember, we always benchmark our ratios. Now, of course, you also want to establish what are the critical success factors for this company. In other words, what key ratio do you need to perform well on to obtain a competitive advantage to generate economic profit for your providers of finance? So once you've established the key performance indicators, then you need to calculate your ratios and look at how the company performed in these areas. Then, of course, follow it back to the management discussion and analysis. Is what you found, have what you found in your ratios, is it consistent with what you found in the management discussion and analysis? So you've got to look at the company's business model and strategy. You'll find that in the management discussion and analysis, and then ask yourself, are what the director's telling you in that management discussion and analysis reflected in the key ratios that you've calculated? Now, our next LOS asks us to prepare a projection of net income and cash flows. So let's project some future performance. The typical way of doing this is to forecast expected GDP growth. Now, in order to forecast expected GDP growth, and we'll see this repeated in equity, typically what we'll look at essentially is macroeconomic forecasts. So looking at macroeconomic forecast, what do you think is going to happen to real GDP and GDP growth over the next period? Once you've established what you think GDP will be in the next period, then you need to think about how that will affect your industry sales. Typically, therefore, what we'll look at is regression in order to do this. So you're going to use some form of regression where you're looking at GDP as your independent variable and sales, for industry sales, as the dependent variable. So, in other words, plug in your forecast GDP growth into the regression to get forecast industry sales. Then, of course, what you need to consider is your firm's percentage of market share, whether that's changed or not over the period. Once you've got your firm's market share, multiply that by industry sales to get your firm's expected sales. You've moved to step 4. Now, once you've got your firm's sales, you can then use that to start projecting your income statement, particularly by using common size income statements. So in other words, in step 5, we're going to be reliant on common size income statements. In other words, using historical margins such as gross profit margins, operating profits, net profit margins. A typical one that's actually used here as well is EBIT, that's a B, EBITDA over sales, because it tends to be more constant over the time than EBIT over sales. EBITDA tends to be more constant over time because it excludes depreciation and amortization, which are two of the most volatile items in the income statement, and of course they're fixed costs rather than variable costs. So in other words, we're going to use our profit margins in order to forecast our income statement. Of course, we need to strip out any non-recurring items from our sales and our income statement, i.e. when we're calculating these historical margins in the past, if there are any items that are not going to be repeated going forward, i.e. transient items, we need to remove them. And there's a lot of subjectivity in doing that. If you see restructuring costs, for example, should they be removed before you start to calculate your profit margins? Well, again, some companies might only have restructuring once in a blue moon. Other companies may actually have restructuring charges each year. So there's a lot of subjectivity in removing non-recurring items. Now, of course, if we're going to use these historical margins, then we're assuming that they're relatively constant over time. So the use of historical margins is not going to be very relevant to new industries where you haven't got a track record, or volatile industries where essentially the margins are changing each period, or high fixed cost industries. Remember, the problem with high fixed cost industries is fixed costs don't vary in line with sales. Whereas by looking at all of our margins as a percentage of sales, we're assuming that everything is a function of sales. So really we're saying that if we're going to use these common size margins, essentially, that we're looking at largely variable cost industries. Now, of course, what we can then do is build a spreadsheet developed based on the estimated growth rate in our sales. So we're going to need to make assumptions about working capital, normally as a percentage of sales, fixed assets and capital expenditure, again normally as a function of sales, cost of goods sold as a function of sales, sales general admin as a function of sales. We're going to need to estimate future interest rates because, of course, that will affect our interest expense. We're going to also need to forecast future tax rates because, of course, that will affect our tax expense. Once we've got all these items, we can produce net income and cash flow based on these assumptions. Okay, well, let's have a little look at an example. So we've run a regression of GDP against industry sales. We've then looked at a change in our market share, and we've decided that our firm's sales in the next period are likely to be 100 million, and we think that they're going to grow at 5% per annum. We've then reviewed our common size statement, having removed any transient items, and we find that cost of goods sold look like they're 20% of sales. Sales general and admin tends to be 40% of sales. We've decided that interest rates appear to be about 5% in the future, so that's based on our forecast future interest rates, and we forecast the future tax rate to be 30%. We're assuming that this company pays no dividends. Now again, we've looked at our working capital, and we've decided that working capital in place is approximately 70% of the next period's sales. And we're starting off with a working capital, non-cash working capital. Now essentially that means it's all of the current assets excluding investments and cash, and it's all of the current liabilities excluding debt instruments. That's our non-cash working capital. In fact, that links back, if you remember, to the indirect cash flow statement where we said we take net income, strip out the non-cash items, and then adjust for working capital changes. Well, we were adjusting for non-cash working capital there. And our fixed capital investment is going to be 5% of next year's sales. Okay, let's put this together. So let's start off with our income statement. So there's our sales forecasted at 100%. We know that our costs of goods sold are 20% based on our common size statements, and our sales general and admin are going to be 40%. And we're going to grow our sales, of course, at 5% each period. So in year 2, our sales are 105, year 3, they're 110. So we can plug in our cost of goods sold and our sales general and admin as 20% of the sales figure and 40% of the sales figure, respectively. You've then got our interest. And remember, we said we're going to work out interest as 5% of opening cash. Now, we haven't got any cash at the beginning of the first year, so cash in the first period is going to be 0. Now, notice we've got our cash. We have got interest in years 2 and years 3, but we're going to have to look at the next slide to actually determine that. Because remember, it's 5% of opening cash, so we need to know what opening cash is before we can actually establish that figure for year 2 and year 3 of 1 and 2 respectively. So let's finish off year 1. Let's work out our pre-tax income. 100 less 60 is going to be 40. And then we can work out our taxes. Our taxes is a fixed rate of 30%. So 30% of 40 gives us 12, taking us to our net income of 28. Again, of course, let's look at it for years 2 and years 3. 105 less 21 less 42 plus 1 gives us 43. 30% of that is our 13 tax expense, giving us net income of 30. And in year 3, we've got pre-tax income of 46, taxes of 30% of that, 14, giving us a net income of 32. Okay, let's have a look at our cash flow statement. Now, of course, from our cash flow statement, we'll actually also see beginning cash, and therefore we'll be able to establish these figures as well. So let's have a look at our cash flow statement now. So remember our working capital. There we go. Our working capital is established as, what did we say it was? We said it was going to be 70% of sales. So working capital in year 1, 70% of 100, 70. Working capital in year 2, 70% of 105, 73. And working capital in year 3, 70% of 110, 77. Now we've also got the net income, of course, which we can lift straight from the income statements in the previous slide. And that was, of course, where do we have our figures? We had net income of 28, 30 and 32. Now we want to strip out our working capital adjustments because what we're trying to get here, of course, is the change in cash. So we're really doing a CFO calculation here. So our investment in working capital, well, if we look at it between the beginning and year one, there's been an increase of 3. Okay. And we know that our fixed capital, well, we said that our fixed capital is going to be 5% of sales, the fixed capital investment. So you can see working capital investment for year one, we've gone from 67 to 70, so that's 3. For year 2, it's gone from 70 to 73, so that's 3. And year 3, from 73 to 77, that's 4. So we get our investment in working capital at 3, 3 and 4. Our investment in fixed capital is going to be 5% of that year's sales. So 5% of 100, 5. 5% of 105 with a little bit of rounding, 5. And 5% of 110, 6. So those essentially are our cash outflows on working capital and fixed capital. So if we take our net income, deduct 3, deduct 5, we'll get our change in cash, which of course is 20 for year 1, 22 for year 2, and 22 for year 3. Now, given that our beginning cash was 0, it means our ending cash for year 1 is going to be 20. Now, of course, our ending cash for year 1 is the beginning of cash for year 2. So we're going to start with 20 for year 2, and remember, the interest expense that we saw on the previous slide is going to be 5% of that beginning cash. So 5% of 20, that gives us 1, which is why we saw interest receivable of 1 on the previous slide. So in year 2, we've got 20, beginning cash, add to the changing cash of 22, giving us closing cash of 42. And then in year 3, 42 plus 22 gives us a closing cash figure of 64. Okay, our next LOS asks us to describe how financial statement analysis can be used to assess credit risk. Now, of course, credit risk is looking at how the issuer of a bond, looking at their ability to meet interest and principal payments as they fall due. Now, of course, therefore, it's going to be dependent on cash flow forecasts, and also it's going to be dependent on the variability of cash flows over time. The bigger the cash flow from operations, the easier it is to meet your interest and principal payments as they fall due. The more stable your cash flow from operations is, again, the better the credit rating we're going to receive. So when, of course, the rating agencies are looking at a company and establishing a credit rating, they're going to look at the 4 C's. Character, which is the track record of the company, it's the qualifications of the people that are running the company, the internal controls, succession planning, etc. Capacity is where we're interested in financial statement analysis, because capacity is looking at your ability to meet the interest and principal payments as they fall due. So that's where our ratio analysis is going to kick in. Collateral, of course, is really looking to see if any asset has been offered as security for the loan. If you have an asset acting as security, it's going to reduce, of course, the risk, because if you were to default on interest and principal payments, you could be put into liquidation. The creditor could sell off that asset in order to recover their cash. And then finally, any covenants. Now again, covenants are going to include ratio-based covenants, and as a result, our ratio analysis kicks in there as well. So let's have a look at our credit scoring. Our credit rating agencies do use formulas that are weighted averages of particular accounting ratios and business characteristics. Now the first thing they'll look at is the scale, which is the size, and the diversification of the company. Of course, what they're particularly looking at here is the impact on earnings volatility. And of course, if they're looking at earnings volatility, then that links into cash flow volatility. And the idea is the more stable your cash flows are, the easier it is to pay off interest and principal, the better the credit rating you'll receive. So they look for the size of the company, they look at the product diversification, i.e. different industries that we're involved in. Again, what you're doing is diversifying your risk if you're not over-dependent on any one industry. And they look at geographical diversification. Again, if we're supplying more than one market, we're less dependent on the performance of one particular market, and as a result, our earnings and cash flows are more stable. Now, next thing is our operational efficiency. And of course, we'll see ratios being used here to establish our operational efficiency, such as things like return on assets, operating return on assets. We know, of course, we look at net income over our assets to get return on assets. Operating margins, things like EBIT over sales, of course, in there. And EBITDA margins, EBITDA over sales. And remember, EBITDA is just operating profits before depreciation and amortizations. The argument is these two items are fairly volatile. If you exclude them, number one, you've got a more stable margin. Number two, it's close to cash because depreciation and amortization are non-cash items. Notice as well, we'll also look at vertical integration here. Vertical integration is looking at whether you own your suppliers and your distributors. The idea is if we do, we're more operationally efficient because we're not going to have to pay a profit to our suppliers. We're not going to have to pay a profit to our distributors. Then our margin stability. So we've looked at some of our margins in step 2 in operational efficiency, but then we're also interested in how constant they are over time. The more stable our margins are, the more stable our earnings are, the more stable our cash flows are, and of course, therefore, we have a better probability of making our interest and principal payments when they fall due. So we're looking at margin stability here, the idea of more stable margins, better credit rating. Then, of course, finally, with our credit scoring, they're going to look at our existing leverage. So they're going to look at coverage ratios of operating earnings, EBITDA coverage, and they're going to look at some types of free cash flow coverage. Remember, our classic coverage ratios were things like EBIT over interest, our safety ratios, looking at how comfortable we're meeting our interest payments. You might want to look at, rather than EBIT, maybe a better measure is to look at CFO over interest. Or even better than CFO, maybe free cash flow to equity over interest. And of course, rather than just looking at interest, maybe you want to look at interest and principal payments on the debt. So it's again looking at how comfortable we're meeting our current interest and principal payments. Okay, and you can see that's a very critical part of the rating formula. The other thing that, of course, we'll look at is cash flow to interest expense, as we mentioned, and also we'll look at things like total debt, some of our solvency ratios, total debt to equity, total debt to debt plus equity, etc. Now, our next LOS asks us the use of ratios in equity screening. Screening, of course, is really setting up a set of criteria in order to pick investments. In other words, in order to choose equities that have desired characteristics for your portfolio. So what you're going to do is you're going to set up ratios and you're going to put some minimum and maximum values on those ratios, and you're going to select stocks that hit those targets. So just notice our investors tend to fall into 3 classifications. Growth investors that tend to focus on earnings growth, value investors that tend to focus on a low share price in relation to earnings. So they tend to look for low PE ratios, low price to book ratios, low price to sales ratios when compared to industry averages or benchmarks. And market orientated, which are really anybody that doesn't fit into the growth or value investor categories. Now, our next LOS asks us to determine and justify analyst adjustments. Now remember, if we're going to compare 2 firms, we need to make sure that their accounts have been produced using the same accounting policies. So we need to adjust one of the company's financial statements to eliminate any differences in accounting choices. So for example, one company might have used LIFO to value its ending inventory, one company might have used FIFO. So again, if we want, maybe we want to adjust the company that's used LIFO to FIFO before calculating ratios. Again, one company might have used accelerated depreciation, one company might have used straight line. So again, maybe you want to adjust the company that's used straight line depreciation to accelerated before you calculate ratios. Again, revenue recognition. Maybe one's used percentage of completion, one's used completed contract. So really all this is saying is we must make sure we're comparing like with like. If you're going to compute ratios and compare between 2 companies, you need to make sure their financial statements have been computed using the same accounting choices. And if they haven't, you're going to have to take one of the companies and convert them so that they're consistent. Now, of course, when we look at international comparisons, this becomes even more extreme because we've also then got to factor in the differences between international financial reporting standards and US GAAP. So let's have a look at a few adjustments that the analysts would need to make. Now, of course, we know with investments there are three potential classifications for our passively held investments. Held to maturity, that applies to debt, which means we're going to see amortized cost in our balance sheet and no recognition of fair value changes. Available for sale, well, we are going to mark to market in the balance sheet, but we're going to take the unrealized gains and losses directly to equity. And trading portfolios, where again we're going to mark to market in the balance sheet, but instead, of course, we take the unrealized gains and losses into the income statement. So again, if you've got two companies using different investment classifications, you'll have to adjust one of the companies so that it's consistent with the other before you calculate ratios. Again, with international accounting standards, you should be aware there's a little bit of a difference in treatment of available for sale securities. And the difference is between US GAAP and IFRS is the difference on exchange rate gains and losses on overseas available for sale securities. US GAAP, you don't have to split the difference in market value and exchange rate out. You can just take it all to stockholders' equity. Whereas IFRS asks you to split out the amount that results from a fluctuation in market value in the security's domestic currency, which goes to equity, and the amount that's as a result of changing exchange rates, which has to go to the income statement. So again, if you've got a US company and maybe an company in Europe that's following IFRS, if they've got available for sale securities and they hold international portfolios, you're going to have to make an adjustment for the exchange rate gains and losses. Inventory methods, well, we know the classics here. Under US GAAP, you can use FIFO, LIFO, AVCO. Under international accounting standards, of course, just FIFO or AVCO. So whether you're looking at comparing domestic companies or companies internationally, you need to make sure that they've used consistent inventory valuation methods. Plant, property and equipment, depreciation methods, accelerated or straight line, but then we also need to look at the assumptions that they've used, such as estimated life, salvage value, and again there's another huge difference here between US GAAP and international accounting standards, and that is IFRS allows you to revalue plant, property and equipment and intangibles to market value and take the unrealized gains and losses into your stockholders' equity. In other words, rather like an available for sale security, US GAAP does not. So under US GAAP, everything's going to be sitting at historic cost, less accumulated depreciation. So again, if you're comparing between IFRS and US GAAP, you really need to look at that plant, property and equipment. Has the company using IFRS revalued? Now remember, with revaluations under IFRS, you may revalue, you don't have to. Goodwill, another classic here. One company has expanded organically, and therefore it's internally generated its goodwill, its relationships with suppliers, customers, employees, etc. And we know internally generated goodwill cannot be capitalized. It's just expensed as it's incurred. Whereas we know if you go out and acquire subsidiaries to grow and you have purchased goodwill, it can be capitalized. Now this is one of the reasons why analysts will often eliminate goodwill before calculating ratios when comparing two companies. Now remember, if you're going to eliminate goodwill in the balance sheet, in your intangible assets, you need to eliminate any impairments on goodwill if they exist in the income statement as well. Off-balance sheet financing, again, finance leases versus operating leases. So maybe one company has acquired assets but uses finance leases. Well, we know there is going to be an asset in the balance sheet, a liability in the balance sheet, and we know we're going to see interest and depreciation in the income statement. Whereas the company using operating leases, no asset, no liability, and we've got rental expense in the income statement. So again, typically what the analyst would do is look at the company with the operating leases, capitalize the minimum lease payments by discounting them, and record them in the balance sheet before calculating ratios. Our second point here, equity accounted special purpose entities, well, they shouldn't really exist now that US GAAP has changed. International accounting standards was always economic substance over form here. So it always said if you have the risk and reward of your special purpose vehicle, then essentially it's a subsidiary and you have to consolidate. In other words, bring in all of its assets, all of its liabilities, and add to the parent company's balances. US GAAP, if you remember, prior to Enron, said if you were not the majority shareholder, you could get away with equity accounting. In other words, bringing in your share of its net assets rather than all of its assets and liabilities on a line-by-line basis. Okay, well remember, post-Enron, US GAAP changed. It introduced VIEs and said now if you have the risk and reward, you have to consolidate. So that's been reduced. But even after Enron, we had this idea of a qualifying special purpose entity that could still be equity accounted under US GAAP. You should, however, be aware that that has now been removed. So we shouldn't really see any differences now between US GAAP and international accounting standards with the treatment of special purpose entities. Finally, sale of accounts receivable. If a company has sold its accounts receivable to a factoring company or a variable interest entity, special purpose vehicle, remember the accounts receivable won't be in the balance sheet and instead will have a gain or loss on disposal in the income statement. Well, again, that means if you're going to compare that to a company that hasn't sold its accounts receivable, you're not comparing like with like. So typically the analyst will reverse the sale of the accounts receivable by putting the accounts receivable back into the balance sheet and showing the proceeds received on the sale as a loan rather than sales proceeds.